What's up, guys? This is Manoj Shoptani. I welcome you all on behalf of the AD world. It's been a fantastic morning outside, and I'm sure that you guys must be enjoying your life to the fullest, guys. Like as usual. Perfect. I get so much boost from your end. I get so much motivation from your end, guys. You guys inspire us, the entire AD team, all of us, like to our core. So this kind of love, the kind of enthusiasm that you pour in your studies, in your day-to-day relief, your life, it's all fantabulous, guys. I must appreciate each one of you. Okay, so guys, in our last video presentation, we did mark the beginning of one of the most fascinating topic of financial management, which is derivatives. That is something which is just a basic extension towards what we learned in our last topic, which was forex. Derivatives is just merely a better and a bigger extension towards the topic of foreign exchange. So we have already covered one particular presentation relating to the topic of derivatives. This is going to be the second video presentation, and I do hope that you guys must have provided due care on your revision aspect. You guys must need to understand this thing that certainly revision is one of the most key essential element that you need to uh, instill in your complete schedule. Okay, without revision, without regular and recurring revision, you won't be able to clear out your C final examination at any cost, guys. So do ensure that you keep revising your topics time and again, because that is something which is extremely important for you guys. So what are we going to be starting in this particular presentation? Are you guys excited to head it up? Perfect. Fasten up your seatbelts. We're about to take off with the first topic of the day, and that will be this, which is margins. So, what is that one thing that I wasn't able to tell you in the forex management chapter? Okay, that is something which is just related towards the mechanism which is being provided by the exchange. Okay, in our country, it's SEBI, which is the stock exchange. Securities Exchange. Earlier, it used to be called as Stock Exchange Board of India. Now its name has been changed and it's Securities Exchange Board of India. SEBI is the one which incorporates and takes care of the entire mechanism of trading in our country. So, what is the relevance of the term which is known as margins as far as our topic is concerned? We'll be understanding the complete thing relating to margins and who all are the bigger and the better players in the industry, who all are the traders and different persons who are taking care of the market in totality. We'll be learning about each one of them one by one. So stay tuned with the entire stuff. I'll make sure that you guys get the complete understanding and get the complete knowledge as far as this margins and related topic is concerned. So let's mark the beginning with the first phase, which is what do we mean by margins? What do I mean by margins? So guys, simple enough. You are a party. Let's suppose you are a party and you want to get yourself involved in one of the transactions, okay, with another person who is available in another part of the country, okay. But then the thing is, you cannot directly contact him up, okay, because there has to be some intermediary between it, okay. You don't know who is the person who will be like selling you this security. He at the other end doesn't know that who will be the person who will be like readily taking up the security, okay, that is you. So who is that particular person who will be actually bringing both of you at one particular place so that you can particularly buy the securities from him and he can easily sell those securities to you? Who is that person? It is none other than the exchange. Exchange will be taking care as an intermediary of this complete transaction, okay. Exchange will be the person who will be ensuring that you don't suffer. Exchange will be the person who will be ensuring that he also don't suffer as far as the transaction is concerned. So you are one of the clearing member. He is also another clearing member. Let's suppose you are clearing member X and he is clearing member Y. The middle person who will be like involved in this particular transaction will be intermediary. That is the clearing corporation as far as the this particular flow of the diagram is concerned, okay. Clearing corporation is the one institution which will be like providing you the securities and which will be the one will be paying him the amount that will be paid by your end, okay. Clearing corporation's basic purpose is that. So now you are clearing member X in this particular scenario. So what you will be doing in this particular scenario is you want to avail the benefit of buying that particular security, that registered trade, okay. So you will be the one who will be buying it. So bot registered trade at your end. He, on the other hand of in another country or in another part of India, he will be the one who will be selling out that particular trade. Okay, so in his position I am marked sold registered trade. What will be done in this particular thing is he will be basically selling it to the clearing corporation. Okay, clearing corporation is none other than the exchange via means of that particular stuff. He will be selling off his securities to the clearing corporation. Clearing corporation, on the other hand, will be buying it and will be providing you the same, okay, in his position. And as far as your thing is concerned, since you want to avail the benefit of accepting those securities, clearing corporation will be selling you them up. So this way, it's going to be a three-way transaction. The person who will be selling out the securities to clearing corporation will be like buying that particular security from him. You, on the other hand, want to avail the benefit of accepting those securities. So the same securities will be sold to you by the clearing corporation. And this way, it will become a three-way triangular chain. Now, this is something which is very normal and which is very understandable in any of the business. Okay, let's suppose you have got your bat in your hand. Okay, there is another person who is having a ball in his hand. You just walk away in your colony and you meet directly that person. That is a simple transaction. If in case that person who is having the ball is staying in another apartment, you are staying in another apartment, there is a person who is staying in the middle apartment and he knows that you are having a bat, he is having the ball. So what he'll do is he'll just directly make you interact. Okay, that is a simple transaction, okay, which I just made you understand with a simple example. Now, what is basically the need of margins in this particular case? Supposedly, let's go ahead with the same example of bat and ball only. Okay, what if you are having a bat and somehow you're not just you don't have that kind of a good integrity in your mind. Okay, and somehow you just meet that person up. Okay, you get in touch with him and you basically take up his ball in your pocket and you just walk away without paying him off for his ball or without getting the uh, like reasonable interaction or playful thing done at your end. What will be like happening to this guy? This guy will be like definitely suffering because of your bad deed. Okay, on the other hand, let's suppose he meets you up. Okay, he takes away your bat without providing you the money, either the money of the bat or maybe something else in the consideration. So what's going to be happening to you? You'll be suffering because of his wrong deed. So, what should be done in this particular scenario as far as this play is concerned? The middle person who is basically making you guys interact with each other, he should be the person who will be like taking up the responsibility of ensuring that you also don't suffer because of your loss of bat, and this person also doesn't suffer because of the loss of his ball. So he'll have to ensure and make some certain kind of mechanism in order to ensure that both of you basically enjoy your play and somehow go back to your home safely and happily. So that is something which is going to be done at his end. Same thing is basically being done by clearing corporations as well, or by exchange. In other words, what they basically do is they ensure that what if tomorrow you don't agree for that particular transaction and somehow once you see that there is a loss happening to your particular portfolio and you back out, so what's going to be happening to that next person? Definitely he will be the person who will be like bearing your loss. So is it really reasonable on the grounds of like integrity and honesty front? Okay, that is something which is just not ethically right. Okay, so in this particular scenario, what basically exchange mechanism does is they ensure that they take up enough amount of margins from both of your pockets that someday if in case any of you fail to provide for the obligation, in this particular case they can directly provide those margins to the other person who will be like really taking up that obligation, bearing that losses. Why? Because of you. So margins is something which protects your interest, that safeguard your interest in the particular transaction and safeguard your interest into the system. That is all margins are all about. Now margins is just not about one particular thing. Okay, margins are for so many different things. There is a initial margin, there is a variation margin, there is a maintenance margin. At the same time, there is a mark to mark margin as well. We'll be understanding about all these things. Now, I just made you understand why margins are usually collected. Simple, in order to protect your interest into that particular transaction. Because what if the other person walks away and he just run away from your dealing, and certainly in that particular scenario you'll be the person who will be suffering all the amount of losses. So the mechanism, the exchange, the clearing corporation, they ensure this thing that because of the integrity failure of one person, the other person shouldn't bear the losses. Okay, if you have made yourself involved in one particular transaction, you'll have to abide by it no matter what. And if in case you run away, still you'll have to deposit your margin first of all in order to ensure that the other person is not gonna be bearing your losses. And that is why margins are being collected. Simple, guys, clear enough? Good. Now, I just made you understand with this why and what type of different margins are available in our country. Not just our country, amongst various other countries. Primarily in India, we have four different margins as far as the textbooks and a bit of practical industry is concerned. Initial margin, maintenance margin, mark to market margin, and variation margin. Now, I'll make you understand each one of them one by one. Okay, let's mark the beginning with initial margin. What do I mean by initial margin? Guys, initial margin is something which is being taken by the exchange right at the beginning of the contract. Okay, you just walk up to a exchange and you say, "Sebi, I want to buy some of your Reliance futures. Okay, will you be able to sell me up?" And at the same time, another person from another part of the country also moved towards SEBI and they ask, "Sebi, I want to sell a Reliance future 3 months forward. So will you be able to buy it from me?" SEBI will say, "Cool, I'll make you guys meet." Okay, with the help of this thing. And at the same time, SEBI basically asks them up to provide for initial margin. That is the thing which is being asked as a margin right at the beginning of the contract. Okay, usually in our country the initial margin percentage is usually of the 10% of the overall contract size. Usually that is something at an average basis I have seen. So initial margin is usually 10% for the total contract value. So initial margin is something which will be asked from your end right at the beginning time once you have decided to enter into the contract. This is what initial margin is all about. Now comes the second one, which is maintenance margin. Now, what do I mean by maintenance margin? What does this name says, guys? Just think about it, and you'll get to know. Maintenance is something that you require on a regular cycle. Okay, you must have got a car in your home. You must have got a vehicle in your home, be it Activa, be it a bike or a car. Okay, you have, every time you see this thing that maybe on a regular basis, maybe on daily basis, or on uh, let's say weekly basis, usually a person comes in at your home and he basically takes up the keys and cleans your complete vehicle and they ensure that the maintenance is properly being done. So what is it all about? Okay, you know that something is happening with your daily transaction and there is a very good case that somehow your vehicle will be like depreciated on a regular basis. There will be the obsolescence damage which is being done to the particular vehicle. So in order to protect your vehicle, you do provide that maintenance. Similar thing is usually happening in the securities market as well. Let's suppose we have provided them the initial margin of 10%. Now, what if tomorrow, because of the contract that you have entered into, okay, you have started bearing some amount of losses. Okay, you have started incurring the losses. And what if your margin, that initial margin, okay, that crosses up? Okay, then what's going to be happening to the other person around? There is a very good possibility that tomorrow you might run away, and what's going to be happening to that person? He will be the person who will be bearing your losses. So maintenance margin is something, let's say if initial margin is 10%, maintenance margin is, let's say, 15%. Okay, that is a maintenance one. You'll have to maintain this particular margin in your bank account, in your demat account, sorry, for all the times in order to ensure for smooth exchange of transaction each day. So let's say 15% is your bar. Once you have touched this particular bar of 15%, okay, then this is an alarming situation for the broker who has actually who is actually entertaining both of you guys. Okay, this will be the alarming situation for them to understand that your securities are going down now. Okay, and you need to buck up. How you can buck up? You just need to increase your margin back to your maintenance margin, that is 15%. Okay, now that buck up, I'll just make you understand this thing with a correlation of variation margin. Variation margin is that buck up. Okay, you have seen that you are incurring some amount of losses, and you have already touched the bar of, let's say, 8%. Okay, you were flying high with a maintenance margin of 20% till yesterday. Now somehow, let's say, with a very common news, that very recent news that has broken in our country, which is the PNB Bank fraud, which just happened. Okay, 11,000 crore rupees. Now the stock prices actually went for a toss. Okay, now what if your scenario would have been a very similar kind of situation? Now you would have been like flying high with your maintenance margin very good at 20%. Now at the very next day, once the fraud came up, okay, you got to know that your maintenance margin has actually flunked till 8%. The initial margin level is 10%. 8% is now your position. The maintenance margin that the exchange and your broker expects you to maintain is 15%. So what should be done? Now there is a lag of 15 minus 8% in this particular scenario. You need to get back to your maintenance margin, not just your initial margin. So that 7% will be again added back. So what is that 7%? That lag is variation margin. Clear, guys? Initial margin is the one which you pay at the very beginning of the contract. Maintenance margin is something you need to maintain at all the times in your demat account. And once margin basically comes down from maintenance margin till initial margin, whatever the kind of buckup that you need to increase in your bucket of margins, that is something which is called as variation margin. Now, lastly comes as mark to market margin. What do I mean by mark to market? Guys, each day the security is trading. Okay, some day it will be like going high, some day it will be going like down. You purchase, let's say, Reliance security at 50 rupees. Okay, tomorrow it just touched the bar of 52 rupees. So now you're into profits. Okay, you bought something for 50, the value of that particular thing today is 52, you are into the profits. Cool. Now what if tomorrow it flunks till 45? You are again into losses now. You're earlier at the initial phase of the day, you were 2 rupees in profit. Now you are 5 rupees down as far as your original position is concerned. So mark to market margin is just that particular transaction, which is 2 rupees going up is will also be encountered in your mark to market margin as profit, then falling for 7 rupees and 5 rupees in comparison with your original value will also be counted in your mark to market margin. So this way, mark to market margin basically works. Okay, it goes up, it goes down, and somehow it is being settled. These three margins, that is initial margin, maintenance margin, and variation margin, these three are the margins which basically take care of the mark to market margin. Once the mark to market margin is actually going and hitting the rock bottom of that particular security, then maintenance of all these three margins comes into the picture. So you need to be aware that all these four margins go hand in hand. Okay, once any one of them is being like suffered onto the factor because of the losses which is being incurred by you as a person, all of them will be hampered. So this was all about the types of margins. Okay, initial margin, maintenance margin, mark to market margin, and variation margin. I hope you guys are clear with each and every kind of example that I made you understand this particular topic with. Now let's move towards the last topic of the day, and that is who all are the major players in the derivatives market. Guys, the number one player is hedgers. Number two, speculators. Number three, spreaders. Number four, arbitrators, and then scalpers, and then day traders, and finally position traders. So now let's understand them one by one. Okay, who all are hedgers? Hedger is basically a person whose main aim is to cover his or her position. Okay, let's suppose you entered into a transaction of buying Reliance futures. Okay, now at the same point of time you just got to know that you actually made up a blunder. Okay, you shouldn't have bought this transaction. Okay, you should have basically sold this up. Okay, so what should be done at the hedger's point of view is hedging is basically a process of protecting your interest. Okay, so hedger's basic job is to protect the interest of the company. They need to safeguard the interest. Okay, so what they'll do is they'll just square off the transaction. If you have bought your transaction in the initial half of the day, now hedgers will be the person who will be like selling off the same and covering themselves in your squaring of the position. So that is what hedger is all about. Speculators, on the other hand, are the person who basically deal with your newses. Okay, they speculate things. Why do I say they speculate things? Okay, they need to know about this particular thing, which is that they expect Reliance futures to go up at the end. other end, they expect the Reliance futures to go down. They are having a very fair idea about the market, okay, at all the times, okay. They already have their private information in their hand. They are very closely associated with some of the giants in the market, and they are already aware of this thing, that what's going to be happening in the next moment in the market. So these are the big giants in the market, and they speculate really well, okay. So speculators are the person who basically involve and make trade only on behalf of that gut feeling, that information, that private information that they usually have, and they just invest their money without any kind of protection of the market. Okay, hedgers are the person who basically protect, or they enter into a transaction protecting the interest of the company. Okay, they usually scare of the positions usually, but as far as the speculators are concerned, they just want to make money because of the speculation, and they know that they have got this gut feeling that yes, share will be going up, so they'll just buy it out. And similar is the case in the vice versa. If in case the share is, they are likely having this feeling that the share will be going down, then in that particular case, they'll just sell the security as soon as possible. So this is what speculators is all about. Next comes in spreaders. There is a difference which is being told as the price that at which you'll be buying something, the price at which you'll be selling something. Okay, as far as the currency trade is concerned, let's suppose the bank will be like providing the security at some price, the bank will be buying from you the security at some other price. So whatever the difference between them is usually called as spread. Okay, spreader is basically a person who knows that in each of the transaction which we have ever seen in our life, there is a particular amount of spread, that is the particular amount of margin that you make. Okay, once they got to know that now the margin has increased, okay, or now the margin between two things, buy and sell, is decreased, they are the persons who come into the picture and who take the real profit out of this particular act. Okay, spreader is a person who usually calculates the kind of spreading, the margin percentage that usually a exchange or a particular stock usually provides you. So whenever they get an opportunity to trade only solely on behalf of the spread, then these are the person who are known as spreaders. They basically enter into a transaction only on behalf of an opportunity, wherein they get to know that here the spread is really powerful to make you good profits, and that's what they all do. Spreaders are basically the ones who will be like taking care of the transaction only because of the spread that they are getting from this particular volume of transactions. Next comes arbitrators. Arbitrators are the persons who really want to just make the money out of this particular transaction by entering into any kind of securities market and any transaction. Hedges, on the other way, they need to protect their interest. Okay, interest of the company. Arbitrators are the one who really wait for the right opportunity. Right opportunity, by that means they got to know that there is a company and its share is going to be like really skyrocketing high, and they've got their entire fundamental and technical analysis done, and they just want to make some real good amount of profits. Then arbitrators are the ones who will be like entering into this particular zone. They just identify the deviations which is available in the future prices and what is the real fair value of the product. Let's suppose for example, let's suppose there is a security ABC company, and their stock is trading at rupees 50. Arbitrator is a person who will be like really finding out what is the fair value of this particular security. And once they'll get to know that the real fair value of this security is, let's say, 45 rupees, okay, it's currently trading at 50 rupees, they'll be the ones who will be the first one to sell off the securities at 50, because they know that the fair value of the security is not more than 45, and they'll be bearing losses if in case they'll have to wait for even a single second. Arbitrators are those persons who basically take decisions only on the perspective of fair value and the future prices, and that's how they make good amount of profits. Next comes scalpers. Scalpers, you must have seen in your regular, let's say, society, or I say the relatives. There must be a common relative friend of ours who was certainly into the stock markets, and usually whenever you ask them up, sir, how do you make money? They'll be like telling you, okay, I just come here for a simple period of time. I just got to know about some good news, and I just make my profit in a few minutes, and I'm gone, and I'm done with my work of the day. These are the persons who are usually called as scalpers. They enter into large transaction, make smaller amount of good money, and they just walk away from the market for that day. They usually enter into any kind of transaction just for minutes, and then they are poof, gone, nothing. So this is what scalpers is all about. When it comes to in comparison with traders, day traders are usually the person who enter into a particular transaction in the morning time. Let's say after 9, once the market starts around 9:30, 9:15. So they just enter into a transaction, let's say around 10, 10:30. And by the end of the day, okay, they square off their position. They just bought something out of the market in the morning time. Now they'll be selling it off by the evening in order to ensure that they don't have to pay for the delivery. They just make some good amount of profit as far as the day trading is concerned, and they are done with their jobs. Scalpers and day traders are only different on one perspective, which is day traders basically trade in and wait for the entire day to close the position. Scalpers is a person who basically ensures that the closing of the position is done in a minute's time, not even days, not even complete day. They just take some minutes and they close their position. That is what scalpers and day traders are all about. When in comparison with position traders, when I'd call about position traders are the person who really hold the security, or they basically sell out the security and then buy it after a later point of time. They don't do it on a complete regular daily basis. They just hold the position for some time. They hold the position for a certain sum of days, and then they exit it. So this is what position traders is all about. I just made you understand what hedgers is. Hedger is a person who will be like protecting and squaring off the position of on behalf of their company in order to ensure that they don't suffer losses. Speculators are the person who basically do their transaction and trading only on behalf of the speculative news that they usually get. Spreader is a person who will be like marking and getting some real good amount of money only on behalf of this spread. Once they'll get to know that the company has been providing you the excessive spreads or decreased spreads, only then they'll be able to make their position in a good manner. Next comes arbitrators. Arbitrators are the person who will be providing you the best of the differential between the fair value and the future value. They'll get to know about the fair value of the company, and accordingly they'll decide whether to invest in it or not, and that's how they basically do it. Scalpers are the person who come into the market, they do their transaction done in just a matter of few minutes, and they just leave the market marking up very good amount of profit with the smaller units. Day traders on different scale, they basically wait for the entire day to they close their position. Till then they usually hold it up, and before leaving for the day, before saying it done for the day, they just leave the market marking and taking their home just the differential part and not the delivery. And lastly, position traders are the ones who will be like holding the securities for some good amount of days, and then they leave the market after making some good amount of margins. So these are the major players in the derivatives market. I hope you guys are clear with each one of them, because I made you understand the same thing with the particular examples. Perfect, guys. So did you really like this particular video? Do you want something more from my end? Surely I'll be providing the same in my next forthcoming video, wherein I'll be discussing with you some good amount of relevant topics there itself. So if in case you've liked this video, if in case you found it informative, do share it with as many friends as you can, because sharing is caring, and certainly that is something we are here for. So thank you on behalf of the Edipedia world. Keep interacting, guys. The kind of queries, the grievances that you usually have, kindly pour the same on our YouTube channel. We'll be the best person to help you up, and definitely we'll find it as a privilege to help you up, guys. Stay connected. That will help us in understanding your needs to way better, guys. I'll see you in the next presentation. Till then, God bless you all. Sayonara. Bye.